Silicon Valley Bank.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The home of billion-dollar ideas and savvy investors. Or at least, that's what it was known as once upon a time. The bank was once highly preferred by most tech-based companies and was even popularly known as the Bank of the Innovation Economy. Founded in 1983, SVB, Silicon Valley Bank, backed companies such as Pinterest, Etsy, and Airbnb. By 2022, SVB was the 16th largest bank in the United States and was famous for innovation and venture capital funding. However, it took about 36 hours for the bank to crash and burn. Its failure left many companies compromised with very few financial alternatives to turn to. But how did the crash happen in the first place? Let's start from the beginning. The Silicon Valley Bank started as an underdog in the world of banking. Nobody would have guessed that the bank would eventually shape the heart of the startup economy. This small, unheard-of bank by Bostonians would eventually become a key player in the economy and support major companies. So, how exactly did the bank rise up the ranks so fast? Silicon Valley Bank, SVB, expanded into Massachusetts, America in 1990, a few years after going public. The company became famous for giving credit to budding startups before this role was temporarily taken over by the state. At the time, banks were also not allowed to accept deposits from local customers. SVB slowly became the go-to source for venture debt. In doing so, the bank rose steadily into a big deal in the banking sector. To capitalize further on the growing economy, the bank also offered banking and loans to venture capital firms and public companies. In 2018, SVB bought Leerink Partners, a Boston-based investment bank, at $280 million. The newly acquired bank catered to the life sciences industry and gave SVB an even wider reach. The following year, 2019, SVB opened its office in the Napa Financial District. The bank also joined funding rounds for many local startups and fundraised about $55 million in 2019 for Boston. In 2021, Silicon Valley Bank purchased Boston Private Financial Holdings for $900 million. This move solidified SVB's footprint in Boston, enabling it to handle tech millionaires' private banking. The bank also gained customers outside the tech and life sciences sectors. Silicon Valley Bank seemed like an unstoppable force, especially when it established its presence in the financial district. However, as the bank's management would soon realize, this great power would bring them great responsibility. Silicon Valley Bank's crisis started from the Russia-Ukraine war. The war caused worldwide inflation that affected the United States by 9.1%. In fact, the Bureau of Labor Statistics termed it as the highest inflation of the decade. Now, here's why the Russia-Ukraine war triggered global inflation. First, Russia is a global supplier of natural gas and oil. The conflict caused a disruption in energy supplies, which caused fuel prices to hike. Secondly, the war caused economic uncertainty, which contributed to fluctuations in the financial markets. Under such circumstances, central banks adjust their monetary policies, which automatically causes inflation. Finally, currency in regions surrounding a conflict can become volatile. Consequently, a weaker currency can increase the prices of imported goods, which adds inflationary pressure. To define inflation simply, it's the reduction in the purchasing power of a currency. A 9.1% inflation rate means that a Starbucks coffee that cost $3.5 would now cost about $3.8. Before the pandemic, the inflation rate was at about 2.5%, and after the pandemic it shot to 5%. And after the war began, it spiked further to 9.1%. Now here is what happens when the rate of inflation increases. The most common thing is that a country's central bank increases the interest rates. In the US, the Federal Reserve announced that it would raise interest rates to deal with the staggeringly high inflation. The impacts of the Federal Reserve raising its interest rates can be felt through commercial banks all the way to the common people, especially when it comes to borrowing. Think of it like this. Just as banks lend money to companies, Federal Reserves lend money to banks and charge them interest. In turn, the commercial banks lend money to the common people. The interest that Federal Reserves charge commercial banks on loans borrowed is called the repo rate. If the Federal Reserves increase their repo rate, then the commercial banks will need to increase their interest rates too to make a profit. This affects commercial banks' ability to give loans and lowers the purchasing power of the people. A low purchasing power means that businesses have to decrease the prices of their products to make them affordable for their customers. Between 2020 and 2022, the interest rate in the USA was 0.08%, which is kind of small, right? Excited at the opportunity, Americans started borrowing millions of dollars at the comfort of the low interest rate. Unfortunately, this did not last long due to geopolitical factors. The war started, and the oil prices and the inflation rate shot up, making the Federal Reserves raise their repo rates. After 2022, the Feds hiked their interest rates by 4.25%. So how did this rise in interest rates affect Silicon Valley Bank? And how did Silicon Valley strategize against these odds? Well, 2020 and 2021 were the two best years for Silicon Valley banks when the interest rates were at 0.08%. Why? For starters, they could borrow money at a 0.08% interest rate and give loans at rates as low as 3% and still make significant profits. In 2021, global venture funding reached $681 billion, which led to a sudden rush of huge cash in the bank's hands. By 2019, deposits went from $61.76 billion to $189.2 billion at the end of 2021. In a bid to compete with the top 10 banks in the US, SVB paid a high deposit rate to attract customers from other big banks. Picture this. While the Bank of America paid an average rate of 0.96% on deposits, the average rate paid by SVB was 2.33%. At that time, the industry average was 1.17%. This meant that customers would get a much larger return on their investments from SVB. As a result, many customers were enticed to deposit into the Silicon Valley Bank. But SVB had made a mistake. When you are a funded startup with a few $100 million customer dollars in your account, it means that you need about $233 million of extra revenue to run your company. The bank now faced a significant challenge. It needed to generate $233 million out of every $100 million. How? SVB invested a whopping $91 billion in mortgage bonds and long-term treasury bonds. These assets would provide stable returns but were held-to-maturity investments. In other words, what separates held-to-maturity assets from available-for-sale assets is the bank's intentions. In layman's terms, a bank's intent for held-to-maturity securities is to purchase and own them for a significant time, or rather, until maturity. Think of it as growing a plant and selling it when it's fully grown. For available-for-sale assets, a buyer can always sell them whenever they want. That's where things started to go wrong for Silicon Valley Bank. Newer government bonds started becoming more attractive, and startups began withdrawing their money from the deposits in the bank. In just 3 quarters, SVB deposits dropped by $20 billion. It was at this moment that the bank realized that its cash was stuck in bonds, and the only way to get it was to sell the bonds and accept the losses. SVB sold its $21 billion bond portfolio of available-for-sale securities. From this, they attempted to raise $2.25 billion from investors as debt and equity, aiming to cover up their losses. At the same time, their clients were pulling their cash from the bank. This caused the SVB stock to plunge by 60% in just one day. Eventually, the bank's trading came to a standstill, and the Federal Deposit Insurance Corporation took over. The insurance company created a new bank called the National Bank of Santa Clara to hold SVB's deposits. Think of it like this: SVB's investments first decreased in value by a huge margin. After depositors withdrew large sums of money, the bank went from solvent to broke in March 2023. What's worse is that the bank's stock is expected to be delisted from the Nasdaq exchange. Investors may have to seek wealth-building opportunities somewhere else. At the moment, SVB Securities continues its independent operations despite its underlying problems. Will you get your money back from Silicon Valley Bank? Well, FDIC insurance will cover you for any money you have in an SVB account up to $250,000. For anything above $250,000, Moody's ratings estimate that people will get 80% to 90% for anything above $250,000. It's not the best deal, but it's better than losing everything, right? Unfortunately, not quite, at least not from a startup's perspective. For decades, Silicon Valley Bank was a dependable banker for early-age startups. Its sudden collapse has sent shockwaves through the world economy. For instance, Y Combinator, YC, is a program run by startup founders who have already built what they wanted when starting and growing a startup. SVB's accelerator YC backs at least 40 Indian startups, and most of them had their deposits in SVB between $250,000 and $1 million of deposits each. Each founder is assigned a dedicated group partner who has mentored many YC companies. Dedicated partners have a lot of data regarding what it takes to build a successful startup from an early age. Silicon Valley Bank was the sole bank for the Y Combinator community, and it accounted for 33.3% of startups. This crisis affects the ability of different startup firms to run their payrolls. After SVB's collapse, Indian startups that had over $1 billion of funds stuck in the bank are now restricted from international wire transfers. By the time SVB's deposits began to fade, it was already vulnerable to losing assets, and startups were the first to feel the wrath. The bank's closure has slowed down the venture capital market funding, which means that startups may face increased difficulties in securing funding. In fact, SVB has about $14 billion in venture debt as part of its assets. These conditions mean that Indian startups with over $1 billion stuck in the bank could suffer multiple consequences. They could be blocked from international wire transfers, be limited in their withdrawal of funds, or get restricted from communicating with U.S. agencies. In a fast-moving world, it is extremely important for an organization to keep its money protected and accessible 24/7. When finances are stuck, startups are forced to rely on alternative measures such as debt to compensate employees. The U.S. president has promised that deposits can be withdrawn from the bank, although it will be hard for companies to meet payroll requirements at the end of the month since the sum can only be withdrawn in installments. If they can't pay, workers and customers will be unhappy. If they're unhappy, the startups might see a downturn and fall into a vicious spiral. Picture this. If a company's money is scattered across countries, it will experience only short-term impacts. However, several Indian software startups were operating in the US as their primary market. India is the third largest startup ecosystem in the world and is deemed the backbone of this emerging economy. The demand for India to build a strong financial ecosystem is rising steadily. Considering the rapid growth of India's economy, its priority should always be to protect the interests of investors. The Indian startup market must learn from this episode that has caused massive disruption in the ecosystem. Silicon Valley Bank became a key player in the banking sector and the 10th largest in Massachusetts by deposits. However, the company's inability to diversify its clientele and assets turned it into hot soup. If the feds hadn't shown up to their rescue, the bank would have started a financial catastrophe across the globe. Since then, many companies among SVB's portfolio companies have opened accounts elsewhere. However, venture capital firms and lobbyists have not yet given up on Silicon Valley Bank. In fact, more than 600, including the New England Venture Capital Association, NEVCA, signed pledges to do business with SVB if it comes back. Here is what NEVCA's executive director Ari Glantz said about the bank. Silicon Valley Bank did a great job of bringing in folks who really had strong startup backgrounds and understood the pain points of early-stage founders and built a brand that was very sympathetic to those struggles. Now, knowing all that, let us consider what immediate concerns are facing Silicon Valley Bank. First, what will happen to the Boston area's emerging startups if nobody buys the SVB holding company? Secondly, what happens if a buyer shifts the focus away from the innovation economy? Well, things are looking better, especially now that there are companies willing to back SVB if it makes a comeback. This is good news for startup founders, as the bank can bring back its support to the startup ecosystem just like it used to. Although it may take a while to rise above the crisis, there is a good chance that SVB will be back. Hopefully, this time it will strategize its treasury investing to avoid unforeseen risks. Silicon Valley Bank may fall, but the spirit of innovation will never truly die. Even during the current crisis, there is still hope, and the future of startups remains undeniably bright. Promising prospects have pledged to support Silicon Valley Bank navigate the turbulent waters. As history shows, the startup ecosystem is adaptive and resilient. Will SVB make a comeback and reignite the world of startups for old time's sake? Well, at least for now, the bank has a contingency plan to compensate its customers. Silicon Valley Bank's story is far from over.